Business Combinations, a guide to IFRS 3. Hey everyone, welcome back to Accountant's Oasis. Today, we're diving into IFRS 3, the rulebook for accounting for mergers and acquisitions, also known as business combinations. Imagine you're a bakery owner and your business is doing great. To expand your reach, you decide to merge with a cupcake shop down the street. This is a business combination, and IFRS 3 helps us understand how to record this exciting new chapter in your financial story. Here's the core principle. When a company, the acquirer, takes control of another business, the acquiree, IFRS 3 sets the standards for how to value and report the new combined entity. Let's break down the key points of IFRS 3. What is a business combination? Think of it like bringing two teams together. A business combination happens when an acquirer gains control of another business, a whole set of activities and assets that can operate independently, generating income. Recognizing the new team players. IFRS 3 uses a method called acquisition accounting. This means the acquirer identifies and values all the assets they're acquiring, ovens, mixing bowls, cupcake tins, and the liabilities they're taking on, rent, supplier invoices. It's like making a complete inventory of your new team. Don't forget the silent partners. Sometimes, in a merger, there might be other owners involved who don't become part of the controlling company. IFRS 3 calls them the non-controlling interest, NCI. Their share of the business also needs to be recognized. Putting a price tag on everything. Here comes the fun part. Valuation. Most assets and liabilities are valued at their fair value on the acquisition date, the price a willing buyer and seller would agree on. It's like appraising all your new equipment. Exceptions to the rule. There are a few exceptions. For example, some initial valuations might be estimates, but IFRS 3 allows adjustments within a year to reflect the actual picture. The value of invisible assets. Don't underestimate the value of things you can't touch. IFRS 3 recognizes intangible assets like secret cupcake recipes or a strong customer brand, separate from something called goodwill. Goodwill and bargain hunting. Goodwill is basically the extra value you pay for the acquired business beyond the net value of its assets and liabilities. Like buying a bakery with a loyal customer base, that loyalty has value. On the flip side, if you manage to snag a great deal and pay less than the net asset value, IFRS 3 calls that a bargain purchase, and you record a gain. Acquisition costs. Who pays for the party? All the fees associated with the merger, like lawyers and consultants, are recognized as expenses, except for costs of issuing new shares or debt. Taking control in stages. Sometimes, control is gained by gradually buying more shares over time. IFRS 3 has specific rules for how to handle these step acquisitions. Beyond the basics. IFRS 3 goes into even more detail, covering things like mergers without exchanging cash, identifying intangible assets, and dealing with pre-existing relationships between the companies. Phew, that's a lot to unpack, but hopefully this gives you a solid foundation for understanding IFRS 3 and how it guides accounting for mergers and acquisitions. Do you have any questions about business combinations? Let's chat in the comments below. Want to learn more? The ISB website has the full text of IFRS 3. Look for online resources like webinars or courses to delve deeper into the nitty-gritty of acquisition accounting. Thanks for joining us today. Stay tuned for the next episode, where we'll explore another exciting topic in the world of accounts and finance.